Dividends are corporate or mutual fund distributions, usually cash, sometimes stock or property. You'll typically see them reported to you on Form 1099 DIV. But the exam loves this twist. Even if you never receive a 1099 DIV, you still must report taxable dividends. Missing form doesn't mean non-taxable. Your job is to put the right type of dividend in the right place on the return. On the return, the first sorting step is, do you need Schedule B? If total ordinary dividends are more than $1,500, you report them on Schedule B, and they flow to Form 1040. If they're $1,500 or less, you can usually report directly on Form 1040 without Schedule B. On the EA exam, they'll hide small dividends across multiple payers. Add them up. Form 1099-D also forces you to separate ordinary dividends from qualified dividends. Ordinary dividends are taxed at regular income tax rates. Qualified dividends get preferential long-term capital gain rates, but only if they meet holding period and other requirements. A common exam trap: qualified dividends are still dividends, so they're part of total dividends for the Schedule B threshold. For 2024, qualified dividends use the same 0%, 15%, and 20% brackets as long-term capital gains. The key idea isn't memorizing every breakpoint, it's knowing the system. Your taxable income determines which preferential rate applies. Also remember, qualified dividends are not subject to employment taxes, so a high-wage taxpayer might still pay only 20% on qualified dividends. Now layer in NIIT, the net investment income tax. NIIT is an extra 3.8% tax on higher income taxpayers, and it can apply on top of the preferential dividend rate. The calculation is mechanical. NIIT is 3.8% times the lesser of net investment income, or the excess of MAGI over the threshold. On the exam, you're usually given MAGI and the threshold, then you pick the smaller base. What counts as net investment income? Think portfolio income like dividends and capital gains, plus many types of passive rental income. Wages and self-employment income are not net investment income, even though they raise MAGI and can push you over the threshold. That's another favorite exam setup. Big wages create NIIT exposure, but the NIIT base is only the investment bucket. Monica and Derek are married filing jointly. They have self-employment income, wages, an IRA distribution, capital gains, rental income they actively manage, and dividends. Their modified AGI is $407,000, and the NIIT threshold for joint filers is $250,000. How much net investment income tax do they owe? The choices range from 0 to several thousand. Think about it. The NIIT is $2,280. First, compute net investment income, capital gains of $40,000, rental income of $12,000, and dividends of $8,000, totaling $60,000. Next, compute excess MAGI, $407,000 minus $250,000 equals $157,000. NIIT is 3.8% of the lesser amount, so 3.8% of $60,000 is $2,280. A tempting wrong move is taxing the $157,000 excess instead. Ethan and Sophia are married filing separately and don't live together. Ethan sells stock at a $4,000 long-term loss. He has no other capital gains or losses. 15 days later, Sophia buys shares of the same company stock. How does Ethan report the sale on his separate return? The options include deducting the loss, limiting it, or treating it as a wash sale. Think about it. It's a wash sale, so Ethan cannot deduct the loss currently. The wash sale rules apply when substantially identical stock is bought within 30 days before or after the loss sale, and purchases by a spouse count even if they file separately. So Ethan's $4,000 loss is disallowed now and is deferred by adding it to the basis of the replacement shares with the holding period tacked. The tempting wrong answer is taking the $3,000 capital loss limit.